Greetings again. If you thought we were having fun on return on assets, now you're going to really enjoy because we have return on operating assets. So we're going to be talking about income from operations, assets from operations. So let's do a deeper dive and jump on in. So we're going to be looking at the balance sheet, operating items, and compute net operating assets. So RNOA, return on net operating assets, not just ROA. So looking at that, operations, we've talked about operations versus investments versus financing, and operations are the mainstream part of the business. So our ROE disaggregation, operating focus recognizes that companies create value through what they do best, their core operations, through their focus of their business. Of course, they can make money on real estate if they sell a piece of property, but that's a one-shot deal. Or they might sell off a division, gains or losses, net of tax. But the idea is they have a business to run, and the core business is what they focus on. Balance sheet and income statement include both operating and non-operating items, and we need to differentiate. The ROA in traditional DuPont is a blend of the return of operating and non-operating operating assets and its non-operating returns. So it is the DuPont is more holistic, including other things. Analysis can and will be improved, which is what we're trying to do, by separately identifying operating and non-operating components and their separate returns to go with it. So what are we talking about? Return on equity. There's an operating return and a non-operating return, two segments. We have the return from what we normally get, the operations, and we have the return from the financing and investing activities, the non-operations. So again, that's that OIF, operating, investing, financing, that we're differentiating. When we did the financial leverage, we actually looked at all liabilities. Liabilities is the money that is borrowed, mortgage, land, interest-bearing. The other operating liabilities, which is the mainstream of the business, more of the current liabilities, accounts payable, and other things that go with that. So we're focusing and differentiating between the two types of liabilities as well. So RNOA, you heard me mention it a few minutes ago. I'm mentioning it again. We have the return on assets, but not just return on assets, return on net operating assets. Net operating profit after tax, NOPAT, net operating profit after tax, NOPAT, divided by the average net operating assets, not average assets, but by operating assets. And we have that beginning plus ending divided by 2 factor. So where do we get these terms? How do we figure out net operating assets? Again, the operating assets come from the mainstream operations. They come from the things we're using, the things we're doing. And net operating assets takes our operating assets and subtracts our operating liabilities to yield NOA. So that's the formula. We have operating assets, OA, minus operating liabilities, OL, equals NOA. And if we look at what our operating assets includes, we have our things like our current assets, receivables, inventories, prepaids. But we also have our non-current assets, our PP&E, our goodwill. We have other intangibles and intangibles in general and other assets. So these are all the assets used to generate operating income. Our equipment is used for our mainstream business of what we're going to be making and producing. Our facilities, our buildings, our environment, our intangibles, our patents, our copyrights. Again, those are all geared towards operations and producing our core business and taking care of our core business. And then we have our operating liabilities. And those are much more geared towards by the way, notice cash is not included, cash and cash equivalents is not included as part of operating assets. So those are things that will be excluded. Cash is excluded when we talk about operating assets. Operating liabilities, we are looking at things like our payables, our accruals, and our current liabilities that go with that. We are not including our long-term debt. Long-term debt is usually borrowing, often bonds payable, that we are using to finance the operations of what we do. but long-term debt is excluded. But we do have things like deferred income tax and other long-term liabilities. So that long-term debt is part of the financing that goes with that, not part of our operations and the funding that goes with that. So that's how we get it. Again, we're yielding our NOA by taking our operating assets, subtracting our operating liabilities to get to net operating assets. So if we're looking at the picture, again, the non-operating assets separate, things like cash, and the non-operating liabilities, things like current debt and long-term debt. So those, the debt obligations, are not operating liabilities. And so we can use the same kind of formula, and we have our non-operating liabilities minus our non-operating assets for net non-operating obligations, or net operating liabilities, obligations. And this is a nice little table. And you can see in green, the things that are considered operating assets and operating liabilities are indicated. Cash and short-term investments are not. Current assets of discontinued operations. They're no longer part of our operations. Current assets not for sale. Current assets held for sale. We're selling them off. Those are not things we're using for the operation of our business. And then loans receivable. Long-term investments in securities, similar to short-term investments, which are often in securities. Long-term assets from discontinued operations are held for sale, but assets used in our business, they're in the green. So we have our property, plant, and equipment. We have the capitalized lease assets. A few years ago, the lease recognition rules changed, and we must capitalize. You say, wait a minute, lease. Okay, I make a regular payment. It's an expense, right? I got a car lease payment. That's on my income statement, right? 5 years ago, you were right. 4 years ago, it changed. So you are now in a situation, and it's been evolving, but you have to capitalize leased assets. Even if you're leasing and renting a building, you're now capitalizing and depreciating, or actually amortizing, anything that of those purchases to go with that. So we have to worry about capitalization of assets that formerly were leased assets. But again, if they're used for the mainstream business as assets, they're covered. On the payable side, on the liability side, the green includes payables and accruals, unearned deferred revenue, and deferred income tax liabilities. But things from discontinued operations or held for sale, not part of it. Interest payable, and I will make an exception there. That's interest if you're not a bank, because interest is the mainstream of a bank. So that would be considered part of their operations. But for most businesses, interest outstanding are not part of the operations. And dividends payable likewise. Bonds and notes payable, capitalized lease obligations. Again, that's part of the lease rules, ASU 842. So what we have here is pension and other post-employment liabilities and deferred income tax liabilities that are included, and then a bunch of other long-term stuff that isn't, as well as all the equity is not included. That's with the preferred stock, the common stock, the treasury stock, all that good stuff. So this is a big picture of differentiating between non-operating and operating. So let's go ahead and take a look at the income statement. So we can do the same thing. We have operating items on the balance sheet, operating assets, operating liabilities. Now we're going to look at NOPAT and our net operating profit after tax. We have to look at net operating profit before tax, and then the tax on the operating profit. So we have NOPBT, sales minus operating expenses. Okay, and we talk about income from operations. We'll talk a little more about that as well. So we've got our revenues, less our cost of goods sold, less our selling, general, administrative, including wages, advertising, occupancy, insurance, depreciation, amortization, litigation, and restructuring expenses. So those are, again, from the mainstream business. If we restructure our main business, there's a lot of that that's been going on as well. You see that pretty regularly. Occupancy is anything associated with rent and tenancy. R&D is expensed in the year incurred. You do not capitalize research and development. This does not show up in the balance sheet. R&D is expensed. Impairments of operating assets, such as goodwill. Impairments are write-downs. It's devaluing of assets that say, wait a minute, we're not going to get what we thought out of this stuff. So we have to take and reflect that on our income statement, reduce our asset, and increase our expense. So that's going to, Increasing expense reduces retained earnings. So our balance sheet, our assets go down, our equity goes down, we stay in balance. Income from strategic investments, non-marketable securities, including joint ventures, partnerships. Those are part of the mainstream. Gains and losses, assets disposal, other operating expenses or income. So we need to break down and analyze and say, see what's going to be included. So again, we're back to the green. Green is a go. Green is operations. And notice the term operating income below. Operating income takes these net sales, and it is net. We're going to have returns and allowances. We're going to have sales discounts, cash discounts, whatever it might be. We have the net sales from stuff we sold, cost of products sold or cost of goods sold, yielding a gross profit. SG&A, selling general administrative, R&D, royalty, amortization, intangible asset impairment, contingent consideration expense, benefit. And again, it's the opposite. In this case, there was a benefit. There was a reduction of expenses or an increase in revenue, basically. Restructuring charges, litigation-related charges, part of our mainstream business, and operating. So our total operating expenses yielding an operating income. Again, notice below the line, below operating income, as I call it, below the line, you have interest expense and other expense. This is not for our mainstream operations. Again, would not be applicable to a bank. And a bank really wouldn't have cost of goods sold. They sell money, so you don't put money as a cost of goods sold. But an interest would be higher up in part of their operations, but not of most other businesses. Other expense, income before income taxes, and then income tax expense or benefits. Sometimes there's carry forwards, carry backs, and benefits and tax benefits that will offset. And we yield the bottom line net income. So our return on assets formerly was that bottom line net income here, the 1671 on Boston Scientific. The return on operating the return operations, operating income is the 1506. Okay, so we have the income from operations. Net operating profit after tax, we have no PAT. All these, they're no longer 3-letter acronyms. We're getting fancy. We got 5-letter acronyms now. Okay, so net operating profit after tax is net operating profit before tax minus the tax on that operating profit, not including those other items that are non-operations. And then we have something called a tax shield. The tax on operating profit is tax expense plus pre-tax non-operating expense times our rate, statutory rate. If you've been following, it was introduced just a few years ago, federal tax rate of 21%. The amount of parentheses is called the tax shield, taxes that a company saves by having tax deductible non-operating expenses. So that's a cushion, that's a shield. By definition, the tax saved by the tax shield do not relate to operating profit. So that's why we're moving out of the picture. They're not part of operations. We're looking for taxes on operations, not taxes on the other stuff. Thus, we must add back the tax shield to total tax expense to compute the tax on operating profit. And our starting point to determine tax on operating profit is pre-tax net operating expenses. So again, if we look at the green and the black, okay, so we have our interest expense, so pre-tax net operating expenses. That's out of the picture, outside the realm, not necessarily what we want to include. We have a tax benefit. And by the way, if we just dispose of a segment of the business, there's tax benefits associated on that as well. And that's, again, outside the mainstream operations. So tax and operating profit, tax expense plus the pre-tax non-operating expense times that statutory rate. All right. And so we have the shield, and that's calculated. We assume 22%. By the way, we have federal and state taxes that we factor in, not just federal tax rates. And then we have net operating profit after tax, which is just up from operations. So that's the key. Looking at the green, calculating based on taxes, based on operations. That's what we're analyzing. That's what we're looking at. Let's go into the next segment of what we're going to be talking about. Return on net operating assets. So you start saying, well, if I got my return on operations, return from operations, and then I have my assets I've calculated, we can pull this together. So we look at this and say our NOPAT over our RNOA. our net operating profit after tax, our return from operations, divided by our average operating assets, not just our average assets, is return on net operating assets, RNOA. Yeah, 3-character, 4-character, and 5-character abbreviations. But these are things you want to know and be aware of. And yeah, these are terms that you probably haven't heard of before. And even if you have, you might be a little rusty. So it's good to jot these down and remember that we're going to be asking for returns. The DuPont was more general. We're also going to get specific on return on net operating assets as we go. So what's Boston Scientific look like? So we're looking at returns, RNOA 12.37%. And our S&P 500 range from 9.3 to 12.5. So we're at the higher end of that range. And would that be perceived as a good thing? I will say normally, yes. Not always. It depends, but typically, you bet. That's a good thing. So RNOA versus ROA. Again, net operating assets versus total average assets. So we're going to see some differences. So we have the numerator effect, NOPAT, net income before of the after-tax effects of non-operating expenses. The denominator effect, average net operating assets, is going to be less than average assets because you're including less assets in the picture. NOPAT is going to be bigger than net income because of the after-tax effect, and the assets are going to be smaller in the effect. Excuse me. So now we're going to this financial leverage and operating return. We're going through and adding those together. Operating return, non-operating return, we're separating the two returns. Excuse me. And then we have the ability to understand and more clearly see how non-operating activities affect the financials and interpret them accordingly. Last segment of this particular presentation, we're going to disaggregate return on net operating assets into profitability and asset turnover. Again, this is on operating profitability and operating asset turnover. We've had before profitability and asset turns, the revenues over assets, average assets on asset turnover, net income over net sales, but now we're doing it on the operations. So again, we're re-emphasizing and deciding that we want to take a look at the return on net operating assets. And so we separate that out, NOPAT over average NOA, which equals NOPAT over sales, and sales over average NOA. And again, sales is from sales from operations. The stuff, the other gains and losses are going to be below the line. They're not from operations, so they're not going to be included in the analysis. We take a look, and we have a net operating profit margin. How much operating profit earns from each sales dollar. Again, the bottom line. How much, we have a dollar worth of sales, how much do we put in our pocket? So in this case, for every dollar, they're roughly taking in 17.68 cents or 18 cents of operating profit after all expenses. Again, there's some below the line stuff to give us a bottom line or some of our basic ratios. But again, operations is key. That's where we're going to know and best predictor of future behavior. I mean, we look at the OIF formula. We say operations, investing, financing, cash flow. Great, we get money for financing. Well, money comes in, somebody paid us money. Does that mean we're guaranteed to succeed? No guarantees. How about we bought assets? We invested in equipment. We bought some machines. We bought some real estate. We make investments. Is that a guarantee of future revenues based on that? And maybe we're making things people don't want. Maybe we just bought a typewriter factory, and typewriter is not real popular these days, although some people have them for collector's items. But the key for projecting the future is our operations. Are we selling stuff and buying stuff and people want? That's going to be the key to understanding our future. And that's what we want to look at. So we have our asset turnover, net operating asset turns. And sales over ANOA, average net operating assets. So we know how to calculate net operating assets. We have our sales, and that's what we're looking at. We're trying to figure out what is the net operating turnover. What's the asset turns or operating asset turnover, OAT, eat your oats. And every dollar of net operating assets, the company earns 70 cents of sales revenue. Okay, so for every buck we have in operating assets, we get 70 cents in sales. Is that good or bad? It depends. Again, it's relative. And then we have NOPM and NOAT. Okay. And if we're looking at net operating profits after taxes over sales, okay, we have a level of gross profit, operating expenses, and we're comparing the competition. Again, everything is in comparison. So how do we change? Well, we can increase sales or decrease average net operating assets. That's going to give us a higher return, a higher turnover associated with that. So either increasing sales for a given level of operating assets or reduce the amount of the assets while generating the same sales, or both. Reducing operating working capital, and we'll talk more about working capital. It's current assets minus current liabilities. Again, those are both operational measures. So we're talking working capital. Corporate alliances, outsourcing, special purpose entities, SPEs, to reduce operating assets. So there are ways of cutting back on assets. We talked a little bit about inventory previously. And if you cut inventory, that actually will help your inventory turnover ratio. Except that if you don't have inventory, it's probably going to ultimately adversely affect sales. So we got to be careful on how we adjust things and evaluate things. And then we have our margin versus turnover. So we have our turnover ratios and our margin. So we're looking at asset turns on the y-axis, vertical axis, and profit margins, operating profit margins, on the x-axis. And operating profit margins up to 25, 30%, and asset turnover up to 2.5, 3. Okay. And if you're looking at profit margins, things that are real profitable with low asset turns, railroads, oil and gas. So we have a lot of assets associated. We've got to have a lot of trains. Electric utilities, you have major infrastructure, major investments. On the other hand, you have household products, commodity level stuff, communications equipment, apparel, automotive retail. Those are much higher asset turns, although they're lower profitability overall. Data processing, and you look at biotech, and that's kind of a sweet spot. Semiconductors seem to have a sweet spot. So is it better to invest in railroads than it is apparel? That's not what we're talking about here. We're comparing within an industry. And there are highs and lows, there are stars and dogs in industries themselves. So this is just just another picture, just another way of analyzing. And then you take a deeper dive within industries and you look at multiple companies and you compare those ratios and analyze within those companies is where we look. So that's where we stand right now. Hopefully the operating assets and then the operating income is making more sense as we talk about it. And then the final video that will be viewed for this module, we're going to be talking about additional analysis, liquidity and solvency analysis with ratios. And we'll still get more, we'll get into the nitty gritty of more ratio analysis. That's key to taking a look at financials, interpreting them, making sense of them. I thank you for your time, and I'm looking forward to seeing you again shortly. Take care.